A central bank meeting in Tokyo has nothing to do with your Bitcoin. At least that's how it feels. So why does Bitcoin keep dropping, sometimes violently, on the days the Bank of Japan makes a move? The answer is one of the largest and least visible sources of leverage in the entire financial system. And it runs straight through crypto. It's called the yen carry trade. For decades, Japan held interest rates near zero, sometimes below it. That made the yen the cheapest money on earth to borrow. So traders did the obvious thing: borrow yen for almost nothing, convert it to dollars, and buy something that actually pays: US treasuries, tech stocks, emerging market currencies, and yes, crypto. You pocket the gap between what you owe in Japan and what you earn everywhere else. Do that with leverage, at scale, and it becomes one of the biggest funding engines behind global risk assets. The whole thing rests on one assumption: that the yen stays weak and Japan stays still. Break either one, and it unwinds fast. And the mechanism is mechanical, not emotional. When the Bank of Japan turns hawkish, the yen strengthens. Suddenly, the cheap money you borrowed is more expensive to pay back. To cut the risk, traders have to buy yen to repay those loans, and that buying pushes the yen up further, which makes the next trader's position worse, which forces more buying. It's a feedback loop. And to raise the cash for all that yen, traders sell what they own. Here's why this lands on crypto harder than almost anything else. When the scramble starts, you sell what's easiest to sell. Crypto trades 24 hours a day, it's deeply liquid in the majors, and it's packed with leverage. You don't wait for the New York Open, you dump Bitcoin and Ether at 3 a.m. Tokyo time because you can. So crypto becomes the pressure release valve for a problem that started in a currency most crypto traders have never touched. It's not that Japan is selling Bitcoin. It's that Bitcoin is the first thing everyone else sells. This isn't theory. In August of 2024, the Bank of Japan raised rates by 0.25%, a tiny move on paper. But the market didn't see it coming. The yen spiked, the carry trade unwound, and the Nikkei fell 12.4% in a single day, its worst session since 1987. Bitcoin went from around $64,000 to near $49,000 in about 48 hours. Crypto saw more than $1 billion in liquidations in a day. Nothing crypto-specific caused it. It was global deleveraging, and crypto was simply first in line. But here's the part most coverage gets wrong. It wasn't the rate hike that broke things. It was the surprise. The Bank of Japan moved without preparing the market first. A hike everyone sees coming gets absorbed. Positions adjust ahead of time. A hike nobody's positioned for forces the disorderly unwind. So the thing to actually watch isn't whether Japan raises rates. It's whether the move lands harder or more hawkish than the market already expects. The gap between expectation and reality is where the damage lives. Which is why a Tokyo meeting can suddenly matter more than a Fed one. When speculative bets against the yen pile up to multi-year highs, the positioning is crowded. And crowded is exactly the condition that makes an unwind violent. So when the yen rips and Bitcoin sags on the very same day, that's not a coincidence to wave off. A Japanese central bank meeting isn't background noise for a crypto portfolio. It's one of the hidden wires running underneath it. The next time Bitcoin drops for no reason, while a currency you've never traded is surging, you'll know exactly where to look. It started in Tokyo. We cover crypto on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.